A midnight meeting on a private island created America's money machine. It started with a few bad mortgages and ended with the world on fire. How did the dream of owning a home turn into a global nightmare? Today, we're breaking down the 2008 financial crisis, the story of how Wall Street broke the world. And trust me, you don't need a finance degree to understand this. We're going to make it simple. So, picture this. It's the early 2000s. The economy is buzzing, and everyone wants a piece of the American dream, a house. To make this happen, banks started offering mortgages like they were free samples at a grocery store. They created something called a subprime mortgage. The word prime means a borrower is reliable, has a good credit score, and a steady income. Subprime is the opposite. These loans were given to people with shaky credit, low income, and a higher risk of not being able to pay back the loan. Why would banks do this? Weren't they taking a huge risk? Well, they thought they had a genius plan. Instead of holding onto these risky mortgages, they bundled them up. Imagine making a giant financial smoothie. You take thousands of different mortgages, some bad, some really, really bad, and blend them all together. They called this concoction a mortgage-backed security, or MBS. Then they took it a step further. They sliced up these MBS smoothies into new, even more complex products called collateralized debt obligations, or CDOs. Think of it like taking that smoothie and baking it into a multi-layered cake. Each slice of the cake was a different level of risk. The top layers were considered super safe, and the bottom layers were much riskier. Now, who decides how safe these financial cakes are? That's the job of the credit rating agencies companies like Moody's and Standard & Poor's. Their job is to taste test these products and give them a grade, like an A, B, or C. But here's the crazy part. They gave the safest slices of these CDOCDs bundles of risky mortgages a OO rating. That's the highest, safest rating possible, the same rating given to super stable US government bonds. Why did they do this? Well, the banks who created the CDOs were paying the rating agencies for these ratings. It was a massive conflict of interest. It's like a student paying their teacher for an A on a test they never even took. With these golden OO ratings, the banks could sell these toxic financial products to anyone and everyone: pension funds, retirement accounts, foreign countries, other banks. Everyone wanted a piece of the action because they promised high returns and were supposedly risk-free. Wall Street was making billions. The housing market was booming. House prices were going up, up, up. It seemed like a party that would never end. If a homeowner couldn't pay their mortgage, it didn't seem to matter. The bank could just foreclose on the house and sell it for a profit because its value had increased. Everyone was winning, or so it seemed. The problem with a party built on a lie is that, eventually, the music stops. By 2006 and 2007, the cracks began to show. Many of the subprime mortgages had low introductory teaser interest rates. When those rates reset to much higher levels, millions of homeowners suddenly faced monthly payments they couldn't afford. Defaults started to skyrocket. People started losing their homes. Remember those financial smoothies? The MBS and CDOs, the ones filled with those same bad mortgages. They started to go sour. The safe tripler slices of the cake turned out to be filled with toxic ingredients. Their value plummeted. Now, here's where things get really scary. The entire global financial system was interconnected, like a giant web. All the big banks, Lehman Brothers, Bear Stearns, AIG, were holding massive amounts of these worthless assets. They had also been using a ton of leverage, which means they were borrowing huge amounts of money to make even bigger bets. For every dollar they actually had, they might have been betting with 30 or 40 borrowed dollars. When the value of their assets collapsed, they were left with mountains of debt they couldn't repay. It created a crisis of confidence. Banks stopped trusting each other. They didn't know who was holding the toxic waste, so they stopped lending to each other altogether. Credit, the lifeblood of the modern economy, froze solid. It's like the oil in a car's engine just disappearing. The whole machine grinds to a halt. In March 2008, the investment bank Bear Stearns was on the brink of collapse. The US government, fearing a domino effect, helped orchestrate its sale to JP Morgan Chase, but this was just a tremor before the earthquake. The big one hit on September 15, 2008. Lehman Brothers, a 158-year-old titan of Wall Street, declared bankruptcy. This was the moment the world held its breath. The government decided to let Lehman fail, hoping it would teach Wall Street a lesson. Instead, it triggered absolute panic. The failure of Lehman Brothers sent shockwaves across the globe. The stock market went into a freefall. The Dow Jones Industrial Average had its biggest single-day point drop in history. People saw their retirement savings, their 401ks, evaporate overnight. The very next day, the crisis deepened. The world's largest insurance company, AIG, was also about to collapse. AIG had sold a type of financial insurance called credit default swaps. Essentially, they made bets that the mortgage-backed securities would never fail. When they did, AIG owed tens of billions of dollars it didn't have. If AIG went down, it would take the entire global financial system with it. This time, the government stepped in, providing an enormous $85 billion bailout. The government was now in a terrible position. It had to choose between bailing out the very institutions that caused the crisis or letting the entire global economy collapse. They chose the bailout. The U.S. Congress passed the Troubled Asset Relief Program, or TARP, a $700 billion fund to buy up the toxic assets from the banks and stabilize the system. The bailouts were incredibly controversial. It felt like Wall Street got to keep its profits from the party, while Main Street everyday people was left to clean up the mess and foot the bill. The result was the Great Recession. Millions of people lost their jobs. Businesses closed, families lost their homes and their life savings. The economic pain was felt in every corner of the globe for years to come. So, who was to blame? There's plenty of blame to go around. The banks for their reckless greed and creation of toxic assets. The credit rating agencies for giving their stamp of approval. Regulators for being asleep at the wheel and not stopping the dangerous behavior. And even the government for policies that encouraged homeownership at any cost. It was a perfect storm of greed, complexity, and a failure of oversight. In the aftermath, new regulations like the Dodd-Frank Act were put in place to try and prevent this from ever happening again. They aimed to make the financial system more transparent and curb the riskiest behaviors. But many argue that the core problems haven't been solved, and the big banks are now even bigger than they were before the crisis. The story of 2008 is a powerful, cautionary tale. It shows how quickly things can unravel when greed goes unchecked and complexity is used to hide risk. It's a reminder that the decisions made in the glass towers of Wall Street have very real consequences for people on Main Street all around the world. So, what's the big takeaway? 2008 wasn't a collapse, was a reset. It forced us to look at the deep flaws in our financial system and question who it really serves. The aftershocks are still being felt today, shaping our politics, our economy, and our trust in the institutions that run our world. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the events that shape our world. We'd love to hear your thoughts in the comments below. Did you or your family feel the effects of the 2008 crisis? Let's talk about it. See you in the next video.